I'm Ben, I'm a finance professor, and today I'm giving my bi-monthly S&P 500 earnings update. This is as of June 6th, 2022. First, why should you care about earnings update? I'll tell you why. If we simplify what affects stock prices into its simplest form, changes in stock prices are due to two things: changes in profits and changes in valuation. What I mean is, stock prices change either because profits have changed or because the value we place on those profits have changed. The value we place on profits is just the PE ratio, how much someone is willing to pay for a dollar of a firm's profit. This valuation, or the PE ratio, will move up and down over time, but over the long run will be near its average and thus only account for a small portion, about 10%, of the long run changes in stock price. Therefore, the most important driver of changes in stock prices, accounting for 90% of the changes in prices, is earnings. So if you care about the stock market, you should care about earnings. This was a very rough week in the markets. The S&P 500 was down 5.5% last week. New inflation numbers were released on Friday. Consumer prices increased by 8.6% in May. This was the largest year-over-year increase since 1981. 417 out of 500, or 86% of the S&P 500 firms, cited inflation in their Q1's earning calls. This is the most firms citing inflation since 2010. The biggest sources of this inflation were gas, other energy-related costs, and things which require gas or energy, like air travel. Energy costs have increased over 40% since last year at this time. Now moving on to the S&P 500 earnings. The estimated year-over-year earnings growth rate for the S&P 500 in Q2 2022 is 4%. If 4% is the actual growth rate for the quarter, it will be the lowest S&P 500 growth rate in the last 6 quarters. So growth is expected to be slower than it has been in the recent past. This earnings growth rate is lower than it was at the end of Q1 on March 31st. At that time, Wall Street expected Q2 earnings growth to be 5.9%. The reason for the decrease is because of the 102 firms that have released Q2 earnings guidance, 70% have issued negative earnings guidance. This 70% number is higher than both the 5 and 10-year average percent of firms issuing negative guidance. So more firms issued negative guidance than usual. The largest source of lower Q2 earnings is the consumer discretionary industry. The estimated Q2 earnings for this industry are 19% lower than they were at the end of Q1 2 months ago. Amazon and Target are the largest contributors to this decrease. As far as stock prices go, this industry is down 20% since the end of Q1. Amazon and Target are down 32% and 28% respectively since March 31st. The second largest source of lower Q2 earnings is the communications industry. This industry's earnings are 8% lower than they were at the end of Q1 2 months ago. Alphabet, the parent of Google, Meta, the parent of Facebook, and Walt Disney are the largest contributors. As far as increases in earnings go, energy and materials have the largest increases since the end of Q1. Energy's estimated Q2 earnings are 30% higher than they were at the end of Q1, while materials are 7% higher. Some large energy firms are ExxonMobil and Chevron. Firms in the materials industry include Dow Chemicals, Nucor, and Sherwin-Williams. While earnings estimates have fallen since the end of Q1, revenues have risen slightly from 9.6 growth to 9.9 growth. This growth, like the earnings growth just mentioned, is driven by the energy and materials industry. As far as profit margins go, the Q2 2022 estimated profit margin is expected to be 12.4%. Once again, energy and materials are expected to have the largest growth, while financials will have the largest decline. The S&P 500 forward PE has been near its 10-year average for the last month. This week, it crossed just below its 10-year average of 16.9 to finish at 16.8. According to this measure, the market is not over or undervalued. If you're interested in the PE ratio, I have a video about that. You can check it out here. At the industry level, the consumer discretionary industry has the highest PE, while energy and financials have the lowest. If we add the median 1-year target price estimates of all S&P 500 firms, we get a price level that is 25% higher than the current S&P 500 price. At the industry level, the communication services, consumer discretionary, and information technology sectors are expected to see the largest price increase, all at least 30% higher than their current price. Wall Street expects a 9% increase in earnings over the next 4 quarters. So if prices rise by 25% and earnings rise by 9%, like Wall Street expects, the new forward PE of the S&P would be around 20, which is about 20% higher than it is currently. In conclusion, the energy industry has the highest inflation as well as the highest profit and revenue growth. One last thing, there was an article in the Wall Street Journal this week by a finance professor that looked at 8 different valuation benchmarks to answer the question, is the stock market still overvalued? I include the link to that article in the description below. In the article, the author author looked at where the measures were relative to their ranges in the last 50 years. For example, he looked at the highest PE and the lowest PE and found that the current PE is in the 58th percentile, which means it is higher than it has been in 58% of the months in the last 50 years. Unfortunately, PE is the only one of the 8 measures that is near the middle of the distribution. The other 7 are between the 85th and 99th percentiles of their distribution, which indicate that despite the large decrease in market prices so far in 2022, the market remains significantly overvalued. The article pays special attention to the cyclically adjusted price-earnings ratio, or CAPE. It is similar to the traditional PE ratio, except the denominator is based on 10-year average inflation-adjusted earnings instead of trailing 1-year earnings. As with the traditional PE, the higher the CAPE ratio, the more overvalued the market. The CAPE ratio is currently 30.4, which is double the average CAPE over the last 100 years. Sorry for the bad news. That according to most measures, the market is still overvalued. Before signing off, I just want to say stocks move up and down over time. Please think twice before selling shares because the market had a bad couple of days. Investing in the stock market is a long-term game. Invest, don't speculate. Buy and hold. You can think of the decline this week as giving you a deal on your next purchase of shares. That's all for now. I'll do this again in 2 weeks. If you thought this was valuable, please punch the like button below, and I'll see you guys in the next one.